Great start of the week of across all the market and especially with AMC, which is always good, guys. Okay, this is great news, but it's just Monday. But I have some better news I want to share with you, and it has to do with hedge funds. It seems like hedge funds are really going through a bad time, really through a hard time and hard season now. And as always, this may have a direct impact on the share price of AMC and potentially the whole short squeeze to come. All right, so let's get into exactly the details about what the heck I'm talking about. This is from CNBC. Let's just listen for a second, guys, and see exactly what is on.
Week is how Goldman Sachs is describing recent hedge fund performance. Chinese ADRs may be partially to blame here, with a third of hedge funds holding an American depository receipt of a Chinese company at the start of the third quarter. Since February, the average Chinese company trading in the U.S. has been cut in half, with most popular ones among hedge funds lagging the less popular ones. Alibaba, for example, had ranked as the top 5 most popular hedge fund holding for 11 consecutive quarters. In 2Q, though, it dropped down to number 7. Other popular Chinese names include JD.com, Baidu, Didi, and Bilibili. Short interest had risen modestly during the first half of the year, but not enough to negate the losses. On the long side, Goldman notes that the, quote, overall popularity of China ADRs registered as the highest in our data history, making clear that hedge funds were generally not prepared for the regulatory shift and its impact on share prices.
All right, guys. Feel free to go and listen to the remaining part of this, interview. Post from CNBC. Right. First of all, this is about CNBC. Hedge funds losing a ton of money when it comes to the investment into one of the favorite stocks that they had so far in China. All of a sudden, China government decided to regulate and crack down into some of the big tech, but also education companies there. And, they started to lose 40%, 20%, 10%. Most of the major indexes, like the Hang Seng, which is the equivalent of the Nasdaq here in the US, dropped significantly since the last 4 to 6 weeks. And because those hedge funds were heavily invested into those stocks, they also lost a ton of money. And because of that, it's really, unusual for hedge funds to lose money, because when they go in heavily. That means two things. First of all, hedges, even though they might be, really equipped in terms of technology, algorithm, and a lot of things they have in order to predict where the market is going and how to use that and put a ton of money into whether they want to buy or whether they want to short sell a stock or a sector in order to make big bucks for their other billionaires clients. So they can also be wrong, or they can also be caught off guard. They can also make mistakes. They can also, predict wrong. All these strategies can go to trash because they are losing money. And for a hedge fund to lose money, it's very unusual, especially when you're talking about double-digit loss performances. Now, the other thing is, remember I shared with you yesterday that Melvin Capital was getting, divested, or let me put it the other way. Citadel was removing $500 million from their $2.7 billion investment into Melvin and Point22 asset management companies. Why? Because so far in 2021, Melvin was down more than 40%. Again, for a hedge fund, that is very unusual. So even if, considering the fact that Citadel is pulling money out, because that investment is not, fruitful, well, you can also expect them to be very, very down on stocks heavily shorted like AMC and GameStop, all right? And that is a good news for us, because it means right now they are vulnerable. Not only they are vulnerable because, they're losing money on some other place, kind of forcing them closer and closer to either selling some other stocks to raise cash, which maybe they've done with the recent sell-off last week we've seen with the whole inflation tapering thing, or they have potentially, pull some money from other investments like Citadel is doing now in order to match those requirements, especially given the fact that we have reverse repo increasingly getting higher and higher, and we have the FICC and the DTCC plus the SEC working together in making sure they regulate and make the market transparent again. It doesn't look good for these guys. So I'm not saying that they're gonna all of a sudden get margin call tomorrow, but it seems like things are getting really tight for them, and that's a good news for us because even in AMC, there are already losing tons of millions, even though they are sitting and sustaining those short positions. But we know it's just a matter of time. So another catalyst we have to watch. But again, things might not happen when we want it to happen because, hey, the only thing we can do for now is buy if we can afford to and continue to hold even tighter. All right. So that being said, for now, guys, I'm out. I'll see you in the next one.